Hi, my name is Josh Mahony, Chief Market Analyst at Scope Markets. Let's take a look ahead to the upcoming Q1 earnings season from the US kicking off this week with a particular focus on the banks. But I'll give you the big picture and then we'll be able to drill down into a few of the key names that we are seeing reporting this week. First and foremost, in terms of market expectations here, it is, according to FactSet, we're expecting to see year-on-year earnings decline to 4.1% from 4.9 last time around. But that apparently gears us up for a particularly strong year ahead, with the expectation that we're going to see an increase towards the back end of the year, where we'd see a whopping 17.6% year-on-year growth in terms of earnings. So things really expected to ramp up over the course of this year, which is highlighted once again here, which is quarter on quarter rather than year on year, which is the prior chart, which shows that while we're expecting to see that a little bit of a slowdown in terms of growth for the first quarter, that's expected to really ramp up over the course of this year, which should provide the basis for essentially tailwinds for equities over in the US going forward. In terms of the expectation for 2025, we're seeing a continuation of that theme. So not only are we expecting to see things improve on a quarter-on-quarter basis, the expectation is that we're also going to see a better year ahead in 2025. And this is all important information, because if you bear in mind that we might see a company outperform on revenues, outperform on earnings, but the stock declines. Well, why would that happen? Well, a lot of the time people care most about the outlook for the year ahead, for the years ahead, for the company, and not necessarily what they've just done in the quarter just gone. So the outlook going forward is going to be absolutely key. And if the outlook is better quarter ahead, better year ahead, then that is bullish for the S&P 500. In terms of looking at where this could come from, well, what's interesting here is that we've, of course, seen this over-reliance on Mag 7 stocks, essentially those top 7 tech stocks, and Tesla really has been letting down the side within that. So people calling it Mag 6 now. But essentially, the expectation is that that growth is really going to temper somewhat and normalize over the course of this year, starting with the first quarter. But that normalization is expected to be replaced by outperformance or a pickup in terms of growth from the rest of the market. And so 2024 is likely, according to this, to be really dominated by the story of a sort of normalization and an improved breadth of gains for the S&P 500 as some of these other stocks play catch up. So certainly if you're looking at things on a sort of sector by sector basis or a stock by stock basis, this is going to be really key as we move forward. In terms of net margins, of course, we've moved through this period where we've seen such incredible inflation, and a lot of companies have managed to utilize that and drive up their margins. Well, the expectation is that we are going to see further improvement over the course of this year, which should help really build those earnings going forward. Of course, you can see improved revenues for a company, but if you don't see strong margins, you could actually see earnings really start to suffer. So margins are an absolutely key part of this. Between revenues and earnings, it's margins that often make the difference and turn strong revenues or even flatlining revenues into bumper earnings. So as long as we're seeing upside in terms of net margins, then it does provide a positive picture for the earnings per share outlook for the S&P 500 going forward. In terms of breaking things down on a sector basis, this is the view from a number of different analysts out there, and the view in terms of where the buy ratings are, where the sell ratings are. Well, by and large, they are bullish. You can see that there's some sort of indecision across some segments: consumer staples, materials, industrials at the bottom end of this. But people are really bullish for the likes of energy, communication services, information technology. Notable that this energy valuation comes despite the fact that energy has been doing particularly well of late. But some might say, well, look, ultimately, this is setting the stage for a bounce back for energy. And maybe this is just the beginning for that. But certainly energy has been doing relatively well of late. Continuing that sector by sector breakdown, we can see here the consensus earnings growth estimates for different segments are very different. The expectation is that we're going to see, for this is full year, Outperformance for communication services, also healthcare, information technology, utilities, consumer discretionary, weakness in terms of energy. So certainly notable that the expectation is that we're going to see earnings growth for this year decline for energy, but this is the segment that people are feeling most bullish about, according to estimates. And that is really an area that is and has been really reliant on what's happening with the underlying assets, much like materials. These kind of stocks are really going to be heavily influenced by what's happening with the asset that those companies are creating. And certainly the strength we've been seeing recently in terms of energy markets pushing crude up through that $90 a barrel mark does provide the basis for optimism for those energy names going forward. Here's a breakdown from the beginning of March on the performance of different segments of the US markets, the S&P 500, consumer discretionary, information technology, real estate, consumer staples, all of those relatively underperforming, either flatlining or slight declines. The top end of this, not necessarily the area where you would want to be unless you're holding these stocks, because you're talking about energy, and energy stocks mean, doing well means that energy is doing well. And when energy is moving upwards, crude oil, natural gas, that really does raise concerns about a potential move higher in terms of inflation. But that has been the theme of late, and certainly energy comes into this earnings season off the back of a period of strength for the likes of Brent crude. Utilities also doing well, which really does highlight the fear within markets, I would say, as people are relatively cautious. So we have been seeing that catch-up play taking hold for utilities. As I said, this week and next really does kickstart earnings season with a big focus on financials. Notably, we're not necessarily expecting all too much, with a 0.7% earnings growth on a year-on-year basis expected for Q1. Q4 looks like where it's at. Certainly expected to see things really build up towards the back end of the year as we see interest rates cut. And, ultimately we're talking about a segment that should benefit from higher interest rates, but a number of the smaller companies within the industry have not necessarily felt that way and have been over leveraged in the fixed income space. So that would really take some of the heat off them once we do start to see interest rates start to come down somewhat. The breakdown does highlight here that the expectation for earnings growth doesn't necessarily come from the big banks. Instead, minus 18% expected on year-on-year earnings growth. Instead, insurance companies expected to really outperform. And it's next week that we do see a handful of insurance companies reporting. So that's certainly a segment to keep an eye out on going forward. I just want to show you a handful of names that are reporting this week, take you through their expected financials, and then essentially show you exactly how things look on the chart. So I'm just going to disappear and we can just look at things on the full screen. So in 3 days' time, you're looking at the earnings for Citigroup. So Friday, all three of these earnings are coming out on Friday. First and foremost, you're looking at a company that I won't worry too much about this number here. It looks pretty daunting, but we did see that underperformance last time around in terms of earnings per share. But by and large, prior to that, this company has generally managed to beat on earnings every single time around. And again, a similar kind of story in terms of revenue. So really underperformed last quarter. But Citigroup will hope to pick things up when they emerge this time around for their Q1 earnings. And certainly this stock has been doing well. The daily time frame shows you that the pullback that we're seeing really does align with a wider trend that has been very bullish and really does hold as things stand. If we see a breakdown through trendline support, then we start to see some questions come into play. But until that happens, we have got this very clear uptrend in play here, and we've got this ascending trend line alongside that. So near-term downside could see the bull step in to buy the dip once again. The trend is your friend, and it does remain in play for now. I would say, as a caveat, if you look at the sort of bigger picture here, we're looking at things here from a sort of multi-year perspective. to the upside, you're looking at the sort of 76 up to 80 as the sort of area that we've topped out in the past in 2018, in 2019, and in 2021. So that does provide room for upside, but it's certainly something worth noting that we have that sort of area of big resistance up ahead. For the time being, pulling back in towards trendline support. Be interesting to see how that one plays out. JP Morgan Chase -9% on against expectations on earnings last time around. But once again, prior to that, we'd seen 5 quarters of outperformance in terms of earnings from JP Morgan. And again, a similar kind of picture for revenues. So a disappointing Q4 for this big bank, but we prior to that have seen them fare very well. So this is going to be a really interesting one as we're expecting to see a pickup up to $41 billion, up around that level seen back in Q2 of 2023. So keep a close eye out for JP Morgan moving forward. In terms of the stock, once again, we have a very clear uptrend that has been playing out. Let me just grab the trend line and see if this sort of tallies up. So you could probably try and cap the bottom two here. Roughly, we've got this trend line here, whether you want to draw it down here and have just the single touch, or whether we want to have one up the top here as well that sort of tries to capture some of the other lows that we have here. Ultimately, you're looking at this sort of span here that could once again see the bulls come back into play. A breakdown through 194 would certainly raise some questions and could lead to a wider pullback. Then we'd be looking down for this swing low here, where you could be looking at a potential Fibonacci retracement into the sort of 189, 192 zone. But for the time being, it looks like we're sort of in sideways consolidation mode. So unless we break the 194 mark, we're heading into these earnings in a pause mode, but that can often happen. That consolidation can often happen ahead of earnings as markets feel somewhat cautious because they don't know what's going to happen next. So look out for this stock. If we break down through 194, we could lead to a wider pullback. But until that happens, it's holding up for the time being, coming into this key area of trendline support that could see the bulls come back into play once again. And finally, Wells Fargo. In actual fact, we saw outperformance on both revenues and estimates last time around. 107 expected on EPS, 2019 expected on revenues. By and large, this is a stock that, if we look at it, has been similarly gaining ground, but much like JP Morgan, has entered this consolidation mode as we head into earnings season. So look out for a breakthrough 56.28. If that happens, then we're looking for a wider pullback. But until that happens, we've got a very bullish trend taking place since those lows in October, November. We're looking ahead to a period that is expected to see the economy start to really gain traction once again as we move throughout the year and we move into the 2025, which looks even better according to those sort of big picture earnings estimates. And that should be bullish for some of these financial names. So keep an eye out for whether we see a breakdown through support. If that happens, then we look for a more bearish environment. But until that happens, we have been seeing these companies faring very well thus far over recent months. And there's a good chance that could continue if the financials can perform well when we see their earnings coming out on Friday in the morning.